The ILO's perspective. The institute where I work, much of the analysis is based on the World Work Report, which is an annual publication looking at labor market and social issues. We also have a series of country studies, one of which was Tunisia, on growth with equity. Basically, how can we use equity to promote growth? It's kind of the starting point. And I think following up on the presentation, basically we had this question that, look, we've had this enormous amount of growth over the past 2-3 decades, particularly in Latin America and Asia, but also in OECD countries. And the question was, where did the money go? So we have this large amount of wealth that's been accumulating, and the question is, where has it been distributed to? With that in mind, I'm going to give maybe just a very quick introduction of recent trends in terms of income inequality. Most of you will be familiar with these trends, but also maybe more broadly from a macro perspective about between labor and capital, where has the money gone from a firm perspective, and what are some of these implications for shared society. On inequality, I will talk maybe very briefly on a few issues of why do we care, focusing perhaps on some of the economic issues, but noting, of course, that there are many, many reasons why we should care about income inequality. And finally, to conclude with some key policy considerations, which I think will overlap a little bit with the first presentation, but maybe add a little bit in terms of some of the policy trends as to what we've seen before the crisis, but also within the crisis, and to what extent that may have actually or could exacerbate some of the trends that we've seen up until now. I think on the first point, from a global Gini perspective, if you will, we can see the breakdown for the world, advanced economies, emerging economies. We can see that between the 80s and the 1990s, inequality almost doubled. Continuing through to the period before the crisis, again, almost tripling. Just to give you a sense that global inequality is rising, and rising at a fast pace. Now, of course, there are some countries within this who have managed to reduce inequality, Brazil, in fact, being one of them. In fact, inequality in Brazil has been falling for about 7-8 years or more, although, as Juan notes, income inequality remains high. So there is some areas where income inequality is declining, but in general, we know that income inequality has been rising and for some time. The small caveat I would mention on this, of course, is that with the limited information we have for advanced economies, as we would expect, income inequality during the crisis is actually falling. So the nature of the crisis has basically destroyed a lot of wealth or income at the higher end. The question is, how long will this last? Theory will tell us that this will happen for a short period of time, but as we recover from the crisis, of course, those vulnerable people who've been affected also by the crisis will have a tougher time recovering. And so then I'll come back to this in terms of the policy responses and how this may affect inequality going forward. In terms of inequality, just a very quick note, the figures are well known, I think, to most people, is that not only has the wealth or income been concentrated in a smaller group of people, but that group of people is actually particularly small, the 1%. And this, of course, has created the Occupy Wall Street movement. We are the 99%, and has raised some considerable issues with respect to social cohesion. So in the case of South Africa, again, as Juan mentioned, the distribution is particularly skewed at the tail, if you will. One thing in thinking about the management, the Maastricht School of Management in terms of inequality for certain workers, one thing I wanted to raise, and this was in our report 2 years ago, was in the US, the development of CEO pay vis-a-vis other workers. And so the first panel, you can see basically that the average growth rate of CEO pay was more or less 20 times that of the average worker, average employee in the US. And as a result, in panel B, you see that in 2007, before the crisis, the ratio of CEO pay to average worker was about 500, compared to 369 only 4 years before. Now, one thing I would also quickly mention here, in terms of the components of the CEO pay, there's been actually, during the period, growth period, there was an increased concentration of stock options, which were, which you could option, if you will, in a very short period of time, which meant that the CEOs were very much driven by short-term firm performance. And in fact, most of the analysis of CEO pay and firm performance shows that there is actually a D-link, grosso modo, between CEO pay and firm performance. And so the question is, you know, CEO of Apple, the late Steve Jobs, of course, had probably the lowest salary, but yet you had very good firm performance. But in general, there seems to be a D-link between CEO pay and longer-term firm performance, which raises the question of pressures of financial markets, which I will come to in a minute. I mean, underlying this is a broader trend of a shift from labor to capital. So this is in our report of last year. We looked at the national accounts of quite a few countries. And between 2000 and 2009, roughly 83% of them showed an increase in the capital share of GDP, which means there's been an increased reliance or shift of income towards capital away from labor. So not only has there been within labor a shift towards a smaller group of people, but more generally, all of the workers have been receiving less of the gains from growth. Also within firms, within advanced economies, we see that the profit shares of financial firms have been growing much faster than that of non-financial firms. One thing I found we were particularly surprised by, if you will, within this chart in advanced economies is that, of course, with the onset of the financial crisis, we see that the profit share or capital share of financial firms was dramatically hit in 2008, but perhaps not surprisingly, due to some of the stimulus or rescue measures, the profit share of the financial corporations in 2009 actually rebounded to more or less levels pre-crisis. Yet the non-financial corporations have continued to decline. One thing to note, of course, is that financial corporations still in advanced economies account for a relatively small share of the overall pie of the profits. But the interesting point, and here I show emerging countries as well, is that what has this meant in terms of two issues, I would say. One is sort of the type of investment, and two is the type of talent. And I think we've done a previous study showing that a significant share of MBAs, a disproportionate share, are moving towards financial firms because of the increased profit shares or talent or pay that's being offered by financial corporations. The second is what we see is, because of these relatively large profit shares within financial firms, we see what we call a financialization of non-financial firms, which means that instead of investing in productive investment, if you will, what we've seen is non-financial firms investing in financial type operations. So before the crisis, you would see a GM, which would then create a financial arm, which would finance the purchase of cars, etc. And this is something which is more or less widespread. So the type of investment is also shifted away from more traditional type productive investment to financial type assets. One thing I also wanted to pick up on, in particular in advanced economies, is the evolution of dividends. So one is, okay, there's been an enormous amount of profits going to firms as a share of total wealth. Much of that wealth has gone to financial firms, but also globally within advanced economies, apart from shifting resources to financial assets, an increasing share of gross operating surplus has been targeted towards dividends, so payouts in the form of dividends. And what we were most surprised by, again, was that during 2008 and 2009, dividend payments more or less stayed the same as a share of gross operating surplus. Even dividends fell slower than gross operating surplus, in fact, which meant that despite falling profits, falling revenues, firms still paid dividends. Now, complementary to this was we did an analysis of dividend yield. which is more or less dividend to stock price. And counter to this, the dividend yield stayed the same or actually increased, which our interpretation is that there is pressure from financial markets to continue to pay dividends as a share of the stock price rather than as a share of firm performance, which again highlights the importance or increasing importance of the financialization of the system across all firms, not just financial firms. Why do we care?